In this video, I want to talk to you about the difference between a venture capital investor and a private equity investor. Now, it is important that you understand this difference, and that's why I created this video, because when you're looking for an investor, depending on what the state is and the stages of your company, you need to be able to screen and find the right type. And the first major point of differentiation is the difference between venture capital and private equity. And that is what we are going to address in this video. I'm going to start with the venture capitalists. Now, they tend to invest at an earlier stage than private equity. So the companies are less developed and they are higher risk. And this means that in return for that risk, they're obviously looking for a bigger return. When the VC makes an investment, that investment typically goes into cash that is then used in the business. It is not used to take, as they say, money off the table, to buy out other shareholders. Other shareholders are left in. Very often they're expected to invest alongside the venture capitalist. But the fact of the matter is that all the money the venture capitalist puts into the business, he wants to see working in the business. Now, very often, as a consequence of this, they take minority stakes. It's actually very unusual for a VC to take a majority position. What he wants to see, particularly early on in Series A, B, or C, he wants to see the founders still with a significant equity stake. And he wants to invest alongside them whilst keeping them very incentivized to perform and to grow the business very rapidly. So the company is very often pre-profit and in negative cash flow, which is why they need the investment. But it is almost certainly going to be post-revenue. So they don't invest in pre-revenue opportunities very often. They make their returns when the company is sold. So when the company exits or is bought by somebody or goes to an IPO, that's when all the investors get out alongside each other. They tend to look for investments which are in potentially very large markets because they're looking for this 10 times, this very high multiple exit. So they're looking for 10 times return on their money. And by definition, there are other things which are important, but we'll come on to those at another time. I'm just focusing on some of the parameters between private equity and venture capital. So that's the venture capitalists. Private equity tend to invest at a later stage. So by this point, the companies are fast growing, yes, but they are cash positive and almost certainly profitable. And therefore, they're more mature, they're more established, and they are lower risk. And often they are quite well-established businesses because what the private equity firm is trying to do is to take over majority control of the company, to have a very high proportion of the equity. Very seldom do you find management already in these businesses with a major stake. They might be a buyout from an existing larger business, but seldom do you find that the founders in with a larger stake. You may even find that the founders are the ones who sell their shares for the next generation of management to come through. So as part of that, you'll find that private equity are really conducting a financial arbitrage transaction. And that is to say, they're trying to buy as low as possible. And then when they exit to whoever they sell to, and it might be another private equity firm, they try to sell high. So buy low, sell high, they make money. They also typically use the cash they're investing in the business to buy out other shareholders. And this is a telltale sign that they're a private equity firm and not a venture capital firm. There may be a little bit of additional working capital made available to the business as part of their investment in order to help grow the business and invest further in the business. And they normally include a package, it's called the sweet equity, in the whole structure of the deal to incentivize the management to return. I'm not going to try to describe sweet equity arrangements, but if you hear the term, then you're almost certainly onto a private equity deal. So private equity is much more financial engineering than venture capital. They tend to have thin equity slices, and then they use leverage, debt, to basically protect their investment because they, as senior debt holders, they have a preferred position to the ordinary equity. They also get a tax shelter on the interest from the equity, so they can actually protect the profits of the company from tax. They don't have to pay so much tax, which is great. for them, not so good for the taxman. So they have a completely different approach, as you can see, to venture capital. So that is the essential differences between private equity and venture capital. And in most cases, technology entrepreneurs are looking for venture capital investors.